Well, good day, everyone, and welcome to today's FS Club webinar. Our topic today is institutional investors' views on the use of share plans, particularly during this COVID-19 pandemic. And I'm absolutely delighted to have as our guests today Lynette Jacobs and Fleur Benns, both from Pinsent Masons. Now, you'll know me. I'm Michael Mainelli. I'm one of the directors of Zien, and it's my pleasure to be able to introduce these webinars. And I say it's a pleasure, principally because our sponsors make it so pleasant and easy and allow us to range widely and freely across a number of topics. Today, as ever, my job is to get out of the way and let you listen to our presenters and ask them questions and participate in discussion. I might point out to you, please, to use the GoToWebinar question facility. I am here with Lynette and Fleur, so I'm not checking my email. So if you use the facility, that'd be great. Otherwise, I'll be picking up your questions after this is over. The facility will, in fact, allow us to send the questions to Lynette and to Fleur afterwards. So if there are any detailed questions, or if you'd just like to get in touch with either of them, please just type that into the question bar as well, and I will pick that up. I did mention our sponsors, and here's a list of them. It's quite a wide-ranging group all over the world, really, as we have many financial centers, law firms, accountancy practices, technology firms, and a lot of people in the fields of technology, economics, and finance. But this is particularly brought to you as part of our ESOP Center work, which is one of the 4 knowledge hubs in FS Club. And within the ESOP Center, we explore all sorts of issues to do with employee share ownership, and things like how we're contributing to Sustainable Development Goal number 10 of the UN, looking at reducing inequality. So a lot of things and a lot of resources online. But as I said, my job is to get out of the way. And if I may, I'm going to hand the floor over to Fleur and Lynette. Ladies, the floor is yours.
Thank you. Thank you very much. Fleur, should we just quickly introduce ourselves? Do you want to speak first?
Yes. I'm Fleur Benns. I'm a legal director in the Share Plans team at Pinsent Masons, based in our London office.
Thank you so much. And I'm Lynette Jacobs. I'm a partner in the team, nominally based in the Manchester office. Previously used to be quite peripatetic, but now tend to work from home those days, as the majority of the country currently. So thank you so much, Michael, for the introduction. If we could now have the next slide, please. I did say please. See, my British culture there. Anyway, the benefits of hindsight. Here we are now, early part of October. Had once spoken to the chairman of a Remco or its members at the start of this year, so back in the early days of January, about the executive pay challenges that they thought that they would be going to be sort of affecting them and concentrating his or their minds. They likely would have referred to executive director pension reductions. That was very high on the agenda. The Institutional Investors Investment Association had all spoken out about how they needed to come down to be equal across the board with all employees, post-termination executive shareholding requirements, and issues that they might be foreseeing with the adoption of their new REM policies in their 2020 AGMs. Obviously, things took a big change as we moved into February, March this year. And they couldn't have imagined at that stage that just a few months on, all the various consequences of COVID that would come in. So first of all, the huge volatility of share prices. Some research showed that between January and March this year, there was approximately 70% of FTSE 350 companies had experienced a share fall of at least or more than 30%. Obviously, as the year has gone by, we've seen share prices going up and down, depending on which sector you're in. Some share price, unfortunately, not recovering yet. Others, moving around a lot. And obviously the consequent effect that has had on executive remuneration decisions. Many companies needed to cut their dividends and also their general expenditure and cash outlay. The High Pay Centre issued a briefing in April this year in which they said that at that stage, 33% of FTSE companies had withdrawn or withheld their dividend payments. And again, that's been a feature that's been going on this year. Employees on furlough, again, in that same report, they said that at that stage, at least 18% of FTSE 100 companies and 23% of FTSE 250 companies were then intending to use the government furlough assistance. And we know that many companies did use it. It's coming to an end in its current form at the end of October this year and clearly everyone's waiting to see what effect that's going to have on redundancies. Companies raise capital from shareholders. It was sort of a more smaller sort of private placing way earlier in the year, but we are now seeing companies going to shareholders in a bigger way now, sort of with larger rights issues. And as we stand now, Michael, Fleur, and I, we were just discussing before, the continued uncertainty. Many parts of the country, including Northwest where I am, have been in local lockdowns. We've been here since the end of July. There's sort of talks that there's going to be a firmer local lockdown on London in the not too distant future. People in general and companies in particular, it's very hard to predict what's going to be going on forwards. So as I said, and thank you for turning that slide, from March onwards this year, there's therefore been kind of huge uncertainty generally, and then particularly the effect that will have on executive variable remuneration. So that applies both of all, sort of initially at least, look at the earlier part of the year, sort of 2019 outcomes. It often made a difference at that point whether a company had a 31 December year end or a year end that sort of fell within this year. So as to whether decisions had been made already, for example, as to bonus outcomes, or whether they were yet to be made at the time companies were first starting to see the effects of the COVID on their businesses. Secondly, 2020 awards. When were they going to be made? How would they be made? Would they be made in different forms? Would they be made on the basis that at the relevant time when they would vest, companies would exercise discretion as to the extent to whether they should vest, and avoid any windfall gains? We saw some differing approaches. So Vodafone announced that it would delay its LTIP grant to November 2020 this year in the hope that that would allow a longer period for the market to potentially settle. That's the benefit of hindsight, and not necessarily going to be the case. And also to assist the company, its remuneration committee, in the difficulty that they'd otherwise have in setting a 3-year free cash flow target in the current circumstances. Marks and Spencer's went ahead and granted its PSP awards as normal in July 2020 this year, but they said that, as they'd already announced in their annual report earlier in the year, that the performance targets for those awards would be delayed until appropriately stretching but realistic goals could be set, and that these would be set and disclosed by no later than the 31st of December this year. Many companies obviously have in-flight awards because awards are made on an annual basis. Companies therefore looking at sort of the position of those, the extent to which the performance targets which were set in pre-COVID times would continue to be a reliable assessment of the profitability and the performance of the company and its executives. It became very clear that remuneration committees and advisors wanted to get some input from institutional investors. What are your views on this? And the other feature that we saw, as noted in the last bullet point there, is that from March this year, we could see executive salary reductions. Again, the High Pay Centre briefing in April said that at that point, 37% of FTSE 100 companies had cut executive pay. I don't know, human beings are an interesting bunch. We saw not much later, a few months later, that some of those pay cuts were reversed, which obviously came with some criticism. Next slide, and I'll hand over to Fleur. Thank you.
Thanks, Lynette. So this part of the talk, we thought we'd actually sort of go back and review what the various institutional investor bodies have said about the shareholder expectations during this period. So first, we're going to look at the Investment Association, which I'm sure you're all familiar with, but in case you're not, it's a trade association for the UK investment management industry, and it's important because its members manage around 35% of UK PLC. So they have a huge sway as to how sort of public companies manage themselves in relation to their shareholders. So it regularly publishes guidelines in respect of executive remuneration. Pre-COVID, this was updated in November 2019. But the Investment Association quickly published a direct response to the COVID pandemic in April, outlining shareholder expectations in respect of executive remuneration. So their response really recognised that in the sort of COVID era, this was not a one-size-fits-all approach, and it stresses that companies are expected to adopt an approach appropriate to their business and the specific impacts of coronavirus. But in formulating that approach, companies must ensure the executives and the general workforce are treated consistently. So that's the overarching sort of approach. As I'm sure you'll agree, and as Lynette has touched on, April now seems a long, long time ago. Things are changing rapidly, and depending who you listen to, we're either in the midst of a second wave or a second wave is imminent. There is, together with the threat of stricter lockdowns, means that the economic uncertainty that arose at the beginning of the year still continues. And there is also, in line with that continued focus and scrutiny of executive pay. So against this backdrop, the Investment Association have promised updated guidance, and we had hoped that might come out in time for this talk, but actually it's going to be around about mid-November that we see that updated guidance. So that's interesting to see. So just a quick recap on what was said in the April guidance. So back in April, perhaps a key concern was in relation to the payment of bonuses for the financial year 2019 and financial year 2020, where companies have suspended or cancelled dividends in respect of the financial year 2019. So this really sort of impacted, particularly in companies with the December 2019 year end. It was sometimes already too late to do anything about the bonuses. They'd already been paid out. And the Investment Association stated it did not expect those payments to be changed, although there remained the possibility of using discretion and or malice provisions to reduce any part of those bonuses which had been deferred into share awards. However, where the financial year 2019 bonuses had paid out in full, there was a strong expectation that come the bonuses being paid in respect of 2020, they would reflect that overall shareholder experience during the COVID period. This has also been tied to a strong expectation that performance conditions for bonuses and in-flight share awards would not be adjusted because of the impact of COVID-19, but instead pressure is on the Remco to use all discretionary powers available to it to ensure a good link between pay and performance, and that executive remuneration outcomes as awards, in-flight awards, start to mature, that reflected the actual performance of the company and the shareholder experience. So next slide, please. So staying with the Remco use of discretion, but this time sort of looking ahead as to awards that are going to be made or have just been made. So where a company had already made 2020 awards prior to sort of March, for example, again, those companies with the December year end might have already made their 2020 awards. The Investment Association confirmed that there'd be no reduction in the size of the grants, but Remco's again expected to confirm that they're going to consider the general market and the share price response over the performance period to ensure that executives do not receive windfall gains on vesting. And so windfall gains, where I mean windfall gains, it's where perhaps awards were granted when the share price was very low. So that means there are a greater number of shares under each award, but as the market recovers, there's gains that are due just to the general economic environment rather than the actual performance of the company. So that's what we mean by windfall gains, and there's expected to be a real focus on those to prevent that happening. So again, the shareholder expectation is that Remcos will use their discretion to reduce vesting outcomes, and they're also being encouraged in the next REM report to outline the approach they'll take to reduce windfall gains and the factors that they're going to consider. Probably most important from a public perception point of view is that executive remuneration is expected to align with the experience of the company, its employers, its employees and other stakeholders. this is particularly the case where the company has sought additional capital from shareholders or has relied on taxpayers' money to, for example, loans or for furloughing staff over this period. And that should be very clearly reflected in executive remuneration outcomes. The press, as I'm sure we've all seen, is very focused on this issue, and particularly in light of expected job losses over the next 6 months and possible tax rises that are undoubtedly coming down the line. Failure to do so and focus on executive remuneration over the next 3 years and beyond is going to have significant reputational ramifications. And then passing back to Lynette. Next slide, please.
Thank you, Fleur. So the ISS, they are a very influential proxy advisor. You often see references in the media where likely contentious shareholder meetings are coming up that ISS have advised shareholders to vote against, or sometimes that they've advised them to vote for. But they are very well known, and what they say is very influential. ISS has also been probably the most vocal in the press as to its views and its advice to the shareholders that it represents and advises as to what they should do in relation to executive remuneration. So we've set out here a summary of those. So in the first instance, for short-term awards, so that is typically your annual bonus, so as opposed to your long-term award, which is your minimum 3-year long-term incentive plan performance share plan award. If there are going to be any changes that are made to the performance metrics or the goals or the targets, so for example, it could be you've got a performance metric, for example, of return on capital, but you're changing the growth that's required under the target level. They want that to be disclosed contemporaneously as to why the company, the remuneration committee, considers that it is appropriate for that relevant decision amendment to be made. They will look on a case-by-case basis, as you can see here, for any changes to be made to long-term incentive awards. So those are your 3 or more year awards that are made under your long-term incentive plan, etc. Although they have indicated they will not generally be supportive. Executive remuneration, as we all know, has been very much in the media's attention over the last few years already. And they are going to be keeping a beady eye over what's going on, and they will be looking for any announcements that may be made by a company, to any alterations that are made to the structure of their long-term plans. And also any repricing actions that are taken. They would want shareholders to be asked to ratify those actions or to approve them before they're made, so don't leave it until too late. Next slide, please. The Pensions and Lifetime Savings Association, that was previously known as National Association of Pension Funds, a UK body. Again, they have issued their thoughts on it. It's a similar theme as the Investment Association guidelines that Fleur referred to before, and equally the ISS. They're going to be watching what companies are doing. They're going to be looking at how they manage the pandemic. That means particularly if they are putting employees on furlough, using one or more of the government's funding arrangements that are available to companies, to see how they then reflect those approaches in their executive remuneration. One of the things that they will be doing is consider suggesting that they vote against directors, and we'll see that has been a theme over the last few years, that as well as shareholders being able to show their dislike for a company's action by either voting against the annual non-binding vote on the remuneration report or the 3-year binding remuneration policy report, also showing their views by not voting against the re-election of directors, which happens on an annual basis. So next slide, please.
So I'm going to look, thank you. I'm going to look at Glass Lewis. Again, quite a well-known name if you're a regular reader of press reports about remuneration outcomes. Like the ISS, it is a US proxy advisory service which gives guidance to institutional investors in respect of voting decisions. So if they recommend a vote against, it's quite a serious and sort of newsworthy outcome. So again, like the Investment Association, in April released its views on executive remuneration, and the key aspects are set out on this slide. Perhaps the key points is the increased shareholder concern relating to the setting and vesting of executive remuneration and how that is going to play out in the COVID period. They are very keen that there's a proportional approach to executive remuneration, and it would, as it says on the slide, it will support any changes and adjustments reflect that proportional approach, particularly where shareholders and employees have suffered during this period, either because dividends have not been paid or employees have taken a pay cut or have been furloughed. There is a real focus on transparency for boards, and the pressure for justification, which is key, engaging with shareholders on these matters relating to executive communication. Boards, Remcos, are expected to rationalise and explain their approach in relation to the decisions that they're making. In addition to this, I think in August of this year, Glass Lewis produced further guidance regarding the payment of executive bonuses, so not particularly in respect of share awards, but in those sort of short-term investment payments. And it confirmed that it would take a pragmatic approach to voting recommendations, but also the guidance it published considers the sort of fate of companies under 4 different scenarios of performance. So it gives guidance as to what it expects to happen to those bonus payments. So for a company where performance has been devastated and perhaps the company is on sort of life support, the expectation is, not surprisingly, that there is no nominal bonuses paid, particularly if there have been significant job losses. But it does make the distinction between sort of forward-looking retention structures, which they do consider as important if there's any potential that the company can survive this period. And so it's very important that Remcos make that distinction between sort of performance-related awards and retention, future-looking awards. Then they looked at company performance that has been moderate but has been negatively impacted. The expectation is there's limited bonus payments made, and there's going to be a strong focus on pay for performance. Any sizable payouts would require, again, that strong justification in order to avoid a recommendation against that bonus being paid. Where you have sort of moderate company performance that, again, has seen a negative impact, but is actually the company's outperforming the market on a relative basis, Glass Lewis is comfortable that provided you have robust sort of performance conditions in place and well thought out arrangements, those arrangements would pay out in that circumstance, but they're again very strong that there should be no upward adjustment for any relative outperformance. And again, if a company wanted to do that, they would have to fully justify that to their shareholders. And then finally, there's sort of fourth scenario is the company performance is strong on an absolute and relative basis. And again, then they split that category into 2 different types. So that's that defensive company that has protected itself, again, expecting a payout in those circumstances. But where there have been sort of, and the phrase is unexpected strong tailwinds. And again, this is that sort of windfall gains where it's not particularly down to the performance of the executive that has driven that performance. Again, that strong expectation that Remcos will look at downward discretion to prevent any windfall gains. So next slide, please. And so looking next at the International Corporate Governance Network, and this is the final one that we're looking at today. This promotes, or the network promotes, effective standards of corporate governance and investor stewardship to advance, and I quote, efficient markets and sustainable economics worldwide. One set of guidelines that it regularly produces is in respect of executive remuneration. So their overall concern is that public perception is that executives earn exorbitant amounts and they are driven by short-term goals. And the concern is that this is only going to be brought into further focus by the COVID crisis. The debate, they're looking at this, potentially invigorating the debate about high levels of executive compensation. They just feel that companies maintaining or increasing executive pay during this period will threaten stakeholders' trust and motivation, as well as the company's social license to continue to operate in the worldwide economy. And this increased attention will highlight the question of fairness. There will be a strong reputational risk for companies that maintains high level of pay and grants large variable pay awards while seeking support from taxpayers or is overseeing large job losses. And the International Corporate Governance Network always looking for less focus on short-term financial metrics and more of a focus on long-term ESG metrics. So that's employment, social and governance metrics. So the next slide, please. So I thought we'd have a little sort of pause and before we look at some more practical issues and look at the sort of key issues that can be drawn from the summary of what the institutional shareholder bodies are thinking. So I think first is that importance of Remco discretion in ensuring that executive award payouts or outcomes are correct for the market. The updated sort of corporate governance code that was published in 2018 provided that schemes and policies should enable the Remco to use discretion to override formulaic outcomes. And so there's a real pressure on companies that haven't already done so, needing to ensure that any plans they operate include such discretions and that the ability to do so is reflected consistently across all relevant documentation in order to ensure that enforceability. So there shouldn't be any confusion as to how that discretion can be applied and what it can be applied to. There needs to be clear legal documents that you can enforce those reductions if you need to reduce awards. I think the focus is very much on sharing the pain. Executive remuneration should reflect both the shareholder and the employee experience. So I think that's key when Remcos are looking at outcomes. Where companies have taken advantage of taxpayers' money and furloughing staff or accepting loans, this has to be reflected in the payments made to executives. And I think they're all across the board. All the investor bodies are very clear on that. And I think, as Lynette mentioned earlier, there has been a sort of movement in recent years for institutional investors to vote not only against the remuneration report or policy, but where they're particularly unhappy against the re-election of the chair of the remuneration committee. So there is an increased sort of focus on personal accountability, and I think that's quite key for companies to take in mind of that move towards that personal accountability. And obviously there's going to be increased focus on the level of executive pay and how that relates to the general workforce. I think this is only going to increase over the coming years as hopefully the economy and markets recover and awards granted perhaps in this year start to mature. The reputational risks that companies face is not going to be insubstantial in this area. It's going to be a real issue over the coming years. So I'm going to pass back to Lynette for the final section.
Thank you. To see the sun is shining in Manchester, I don't know.
Yes. Eventual move to Manchester.
Yes, absolutely. Don't mind local lockdowns for a sustained period. Anyway, sorry, go back to what we're talking about. Yeah, I mean, where we are now in the year, we're obviously sort of majority of companies, AGMs have been held this year. What's interesting is that overall, the votes in favour of directors' remuneration reports and the normally three-year remuneration policy votes as well, have consistently sat at 90% or more over the last 5 years. So, that is of interest because everything that's been happening, there is still that basically high level of approval. That said, we have seen an increase in companies with votes of 20% or more against some of the votes. 20% is an important threshold. Fleur's been referring to the corporate governance code that was updated last in 2018. And one of the changes made at that time is that where a company has a vote of 20% or more, in the first instance, when it issues the voting results on the day of the AGM, it has to sort of refer to the fact that it had a 20% that's considered a significant vote against, and sort of they'll often sort of give some explanation to a greater or lesser extent to sort of why they think it happened, and that they may have already had consultations, but they'll be discussing further with their larger shareholders as to what they can do. Secondly, they are then required 6 months later following the AGM to give an update as to where they are in their discussions and how they're going to be taking things forward to hopefully have higher levels of approval going forwards, although you'll see in some of the examples I'm about to give that doesn't necessarily change from year to year. And thirdly, then they have to give a final summary of what happened in relation to that over 20% dissenting vote in their next annual report and accounts. It's not necessarily that all these votes against have been related to remuneration, but some definitely are. So you can see here that 40% of slightly over 40% relate to remuneration issues, and more than 30% relate to re-election of directors. And as I said just before, that is a way in which shareholders are now showing their disapproval of decisions that are being made, particularly in relation to executive remuneration. So you might see sort of the CEO or the chairman, or also quite often the CEO of the remuneration committee, where shareholders show their views by voting against their re-election. It's too early really to see sort of the COVID impact in cases, but we think that next year, sort of 2021, that's when you'll be likely to see the results sort of shown in shareholder votes, because then we'll be seeing sort of bonus payments. So what happened to the bonus payments this year, as I said when I spoke earlier, for many companies had already, especially December 31 year-end companies, had already made their decisions about what bonus payments were going to be for this year, to be paid out this year, but clearly it will be much more relevant when it comes to the payments that are going to be made early next year. Also vestings, so awards that will vest during the course of next year, if there are any kind of adjustments made to those. So that will be one to look out for next year. And by way of example, we've got a couple of slides now that are based on September AGMs. We've selected some from the travel sector, because obviously everyone knows that is a sector that unfortunately has been very hardly affected by COVID. Ryanair, not sort of a company that is known for sensitivity towards executive remuneration, and they don't generally have very high votes in favour. But that said, this year the AGM was held on the 17th September, and there was a vote of 34% against the remuneration report and 27% against re-election of directors. What they didn't like was the fact that Michael O'Leary had a very large pay package overall. He is of 3.2 million for the financial year that ended in March this year. His bonus payout was £419,000, which was a little less than the potential maximum of £455,000. And ISS, as I said before, they had voted in advance. They had advised shareholders in advance to vote against. And you can see here the reasons that they gave for that. That many other companies in sectors that had been less affected by COVID, had deferred or cancelled their executive bonus payments, hadn't only sort of sliced around 30,000, less than 40,000 off the bonus of the CEO. And it's just felt, as everything we've been saying, Fleur saying the key themes, you've got to look at the wider workforce experience, you've got to look at the wider community experience, and therefore it is not appropriate to have only an 8% reduction there. IAG, this is the parent company of British Airways. Again, shareholders were not happy. The remuneration report was passed, but there was a 20% bonus vote against. Here, what they didn't like, as you can see here, is the fact that Willie Walsh, it was his last year before he was bowing out, he nevertheless had this bonus of £833,000 out of his total pay package of just over 3 million. This was at the same time, sort of against the background of IAG had cut more than 10,000 jobs, and they are also now seeking shareholder approval for a rights issue of just under £3 billion. Again, look at the picture as a whole. Is it appropriate for these payments to be made? And that is the end of the formal part of our session. So, Fleur and I thank you very much. If anybody has any questions that they would like to ask, we'll be very happy to address them.
That was superb, Lynette and Fleur. What I really like is the fact that you're bringing to bear an area that people have sort of ignored. It's become a kind of a running thing over the years that executives have these outlandish pay things, but ultimately it's just sort of waved through at the AGM. So I think this is really an interesting point about COVID. I certainly hadn't appreciated until you came up with the idea for today's presentation. Anyway, we've got a few questions coming in from the audience, and I'd like to start with one, which is really to do with taking money from government. I mean, at first glance, this seems very, very simple. I sort of just deduct the people on furlough, or I look at sort of a commercial rate for a loan against whatever has been done. But couldn't this be an extremely complicated area? I mean, I could imagine things where, for example, I'm looking at reduction in import duties on PPE equipment. I'm looking at things that the government is doing with regard to direct subsidy in particular sectors. How do you think this is going to be calculated?
Certainly.
Sorry, I think this is one of the ones that is going to be where Remcos have to have a particular focus on public perception. So I think where there is a very clear link between sort of taxpayers' money and the company, i.e., where you're furloughing people, or the sort of tax-free loans, for example, where they've taken advantage of that sort of taxpayers' money. And I take your point that there are other aspects, but those are the ones that sort of, the newspapers and people are going to be really focused on, where you've, furloughed all your staff, or taken sort of tax-free loans, and are therefore using taxpayers' money to continue, and the need for the company to continue, but you see an executive still taking a huge bonus or paying out massively on share plans. That's when you're going to have the issue, and that is what the press is going to be focusing on. And I think it's that reputational aspect of it that Remcos are going to have to be really, really conscious of.
Well, continuing down that line, Elizabeth in East London is sort of curious. She's looking at the gender pay gap as well, and many of the frontline workers seem to be preponderance of women. So is this going to exacerbate some of the questions at AGMs in that regard?
Oh, I'm sure, because I agree. All the news reports are. Sorry, it seems like Lynette's frozen, but it seems all the news reports and the analysis is that women are being disproportionately affected by this epidemic, this pandemic, and it's not just key workers, but because they tend to take on more childcare or sort of elderly relatives and things, that that sort of working from home issues have had a disproportionate impact. So I'm sure, yes, that is something that Remcos are going to have to think about carefully as well. I mean, there's always a lag, isn't there, as to when that data comes out. So that's, but yeah, I think it's going to be a focus for years to come when we see what the impact of that is going to be.
I mean, there's a tremendous amount of post hoc, after the event rationalization implicit in a lot of this that we've never seen before. I mean, it's normally been seen that basically I'm taking a bet with the management. If they perform, then they get a lot of cash. If they fail to perform, and I know it's not worked out that way, and many of these seem to be one-way systems. But do you see this as the first thin end of a wedge of increasing post hoc evaluation of schemes?
I think this has been coming, and we saw that in the corporate governance code in 2018, that there's sort of downward discretion on formulaic outcomes, to reduce those awards. So I think this was already coming, and we have seen over the years that increased focus on executive pay. So I think, it's accelerating that focus perhaps, rather than being the start of it. I think it's just put it more into the spotlight. Lynette's back, I think. But great. You're on mute. We can't hear you.
Still can't hear you, Lynette. We seem to be having a bit of a technical, but Lynette will come in, I'm sure, when we can get a moment there. Don't quite know what's wrong there. Let me just start a quick another question. I'll just see if the team can get behind the scenes and help Lynette there. One of the things on my mind is that when you're looking at these sorts of schemes and you're taking into account the wide variety of the schemes, yet they're reported in the press in such a simplistic way. Ian Harris is sort of asking about this as well. How do we get these complex issues over really to the population when the principal medium seems to be the press?
Well, that's a difficult question, yes. And I suppose it is companies managing that message. But how much time and energy do you spend in doing that? But I think the continuing trend is that trial by press. I think as we mentioned there is that view that generally accepted that executive pay is out of control, or generally accepted by the press that executive pay is out of control and the fat cats, and I think that is just going to continue. So I think it's companies managing that. But yes, you're right. Something that actually makes sense and that shareholders are happy with, when it actually happens, can be torn apart in the press. And that is something that's going to be difficult to deal with.
I apologize for whatever reason the technology seems to be letting us down with Lynette. I'm sorry about that. So if I could throw another question to you, Fleur.
Sign language.
Yeah. Well, I'm glad we got Lynette for the presentation,
Yes.
Particularly the end there, which I think was really good to see that this is already happening. And I think it was very good that you chose the transportation sector. In the time available, I might just kind of close on one question, which is sort of bothering Ian in West London, for that matter. And that's really, we here at the ESOP Centre are very interested in employee share ownership. And it would seem to me that if I'm trying at an AGM to produce, a statement and to get it approved, would I not be smarter to have an all employee share plan in which the executive remuneration was effectively just a well thought through chunk of that?
Well, I mean, that is a different topic and a topic for probably another talk, but employee share plans, yes, I think can be used effectively, particularly when you're looking at employees facing pay cuts or pay freezes. And so actually, companies should be using all the tools in their inventory to sort of lessen that blow. I mean, obviously there are limits, particularly for sort of save as you earn or share incentive plans. They are limited in what benefits they can give, and so generally you don't see executives. They might participate, but the long-term incentive plans and the short-term incentive plans are in addition to those.
And just maybe a final point here, and obviously talking to lawyers, so I'm very curious what you think. Should people be going to AGMs, really having, particularly in the case of the sort of the government and the general economic look back, should they be coming with more deeply prepared plans, more deeply prepared statements about why they're giving this award, or should they pretty much sort of throw it to the AGM and say that we've given a lot of thought?
It is all about the narrative, and that dialogue with shareholders, and I think Remco's and companies are being encouraged to have that very open dialogue with their shareholders in order before they even put it to them at AGM, so that they are comfortable that their shareholders are happy with what is being proposed. I think it is that ongoing engagement. I can see Lynette's itching to say something, but
oh. Well, we'll have to have you back anyway, otherwise but sadly we've come to the end of time. I've got a lot of comments here from people thanking both of you for really highlighting an issue that I think it's skipped the attention of a lot of us. It's often seen that sort of preparing for the AGM is left to the company's SEC or something like that. And this is really, really good for you to highlight that this is coming forward. I happen to sit on a board at the moment, which has been heavily affected by COVID, for the benefit of the company, actually, in some regards. And I'm certainly going to be highlighting this as a non-exec on the Remcom myself. So thank you for that. Anthony Abel, in particular, is giving you some profuse thanks in the question box. So I'll leave it be. It's been fantastic. If you give me just a split second, just to say a couple of things in closing. Firstly, a reminder, everyone, that there are a tremendous number of resources at the ESOP Center, not least our monthly news pad written by Fred Hackworth, absolutely fantastic. And this month touches on a lot of the issues to do with what are going on in AGM. So please do check out Newspad. We also have a number of bulletins. There's something like 500 bulletins in the FS Club, and several of them are very related to employee share ownership, and they're free to subscribe, and they come out weekly. I must thank, of course, our sponsors again for their generosity and tolerance. They're a great group of people who let us range widely and freely across all sorts of subjects, and I think today is a good example of that. And so well done to Pinsent Masons for doing that. Finally, I would just like to remind you that the webinars are coming up. Don't ask me, but yes, we do have one on real tennis, and that's coming up tomorrow. But it's because it's revolving around one of our favorite financiers, Sir Thomas Gresham, 1519 to 1579. Many of you in FS Club will know we have a small obsession with this gentleman. But we are also looking at some other topics, the use of technology in areas like hostile profiling. We'll be focusing on Labuan. Labuan's doing some intriguing work, believe it or not, on equality internationally and the role of an international financial center across the third world in terms of helping to promote equality. And finally, another session related to employee share ownership, selling your company next week. So these are all coming up, and many more besides, stretching already into January and February next year. But most importantly, I really need to thank very quietly Lynette, who's been very disciplined here on the phone, and Fleur for putting together such a cogent presentation. It sounds like something we might want to pick up again next year to see how this pans out, because this is the tailwind of people looking at post-hoc rationalization of awards. It's going to become an increasingly topical subject, and one very related to issues of quality. But in terms of thank yous, sadly, the technology may have failed us and Lynette on Q&A, but it also fails us in giving you applause. And so I have here my Korean karmic clapper from my Buddhist monastery in Bugoksa, and I just wanted to say
thank you very much
for your contributions. We hope to have you back. So take care, one and all.
Thank you.